Yeah. And here's the thing, guys. This is what I will tell you. No matter what we talk about on this particular call, no matter what the market does, there's going to be opportunities. To me, the market is not good. It is not bad. It is different every single year. And there are opportunities every single year. So a lot may look at what I'm going to share with you guys on this call as doomsday or bad or market crash. Like the market is cyclical, right? What goes up comes down, and what goes down always comes back up. It always has since the beginning of time. And so that's what we're going to dig in here today. So before I jump into it, because I'm going to start with kind of a rant before I actually get into the presentation and stuff that I put together. But anybody else have anything that they absolutely have to share with us for today before we get into it?
Larry, I'm driving right now, but I want to give a huge shout to Jeff and Kelly. Thank you for presenting the AllianceRE.com website this morning on your call. I got a call from Sean, actually, Larry, just now before the meeting, saying it was sick and congratulating us on building that out.
Beautiful. That is great. And yeah, like guys, this is I mean, man, the amount of support that this group and all of you guys put into this, like that's the magic, right? Like that's where everything really comes together is through the community. It's not one particular person, one particular team or anything like that. It's everybody that kind of combines. So thank you guys. We're approaching 70 people and stuff on this call. And I want to be respectful of your guys' time. And I want to jump into this. Here's the thing. Kelly, can I share co-host and can you manage the waiting room for me? Is that possible?
I sure can.
Wonderful. Thank you so much. Just because like once I get going here, I'm going to get all amped up and then I'm going to forget to look at that. And then people are going to be like, I was in your waiting room for hours. And I'm like, whatever.
No problem.
All right, guys. So here's the thing. There is an indicator that has predicted every single recession since 1950. Not most of them, every single one. It exposed the 1973 oil crisis before it happened. It called the 1980 double dip recession. It warned about the 2001 dot-com collapse months before it actually finished. And it flashed red in 2006, 2 years fully before Lehman Brothers went bankrupt. It exposed the 2020 crash weeks before COVID was even a headline. Remember when we were in real estate and the real estate market stopped for 3 months? We had no idea what was going to happen. We couldn't show homes. People couldn't get into homes. We couldn't leave our houses, right? Its track record is perfect every time. It has never had a false positive in over 70 years. Now, here's the thing. The Federal Reserve knows about this indicator. Wall Street watches it religiously, but for some reason, it never makes the evening news. They never teach it in school. And right now, that indicator isn't just flashing a warning sign, it's screaming. The signals actually started triggering in about 2023. And if history holds, what comes next is not going to be pretty. The indicator that I'm talking about is called the yield curve, specifically the spread between the 10-year Treasury yield and the 2-year Treasury yield, right? And now, before you guys start zoning out because that sounds boring as hell and complicated, just give me 60 seconds and then I'm going to share my screen and we will go through a lot of these things a little bit more in depth. Because once you understand what this is, you're going to see the economy completely different. And you'll wonder why nobody has ever told you this sooner. And here's the simple version, right? When you lend somebody money for a long period of time, you should demand a higher interest rate. That's common sense, because if I lend you money for 3 months, I'll charge you less because I'm going to be getting it back sooner. But if I lend you money for 10 years, I need to make more on my money because that locks up my money for a longer period of time, and I can't use it for other opportunities in the market. So I have to be compensated for that. So more time means more risk. More things can go wrong. So you want more of this reward. Here's the thing. The government borrows money by issuing treasury bonds. 2-year bonds, 10-year bonds, and 30-year bonds. They're all different lengths with different interest rates. And under normal conditions, longer bonds pay interest rates that are higher than shorter bonds. Makes common sense. That's called the normal yield curve. But sometimes, very occasionally, something strange happens. Sometimes short-term rates rise above long-term rates. The 2-year treasury starts paying more than the 10-year treasury. That's called an inverted yield curve. And when the yield curve inverts, recession follows. Always. And let me show you kind of why that matters, right? The yield curve inverts when investors believe the future is going to be worse than the present. Think about that for a second. If you thought the economy was going to be booming in 10 years, you would demand a high interest rate to lock in your money, to lock your money up that time. You'd want to be compensated for missing out on all of the additional opportunities. But if you think that the economy is going to be struggling in 10 years, if you think the growth is going to be slowing down and interest rates are going to fall, then you're actually happy to lock in today's rates for the long term. You accept a lower rate for 10 years because you think it is the best that you're going to get. When millions of investors make this calculation simultaneously, the yield curve inverts. It's the bond market voting on the future. And the bond market is a hell of a lot smarter than the stock market, because the stock market gets excited. We chase momentum. They buy things because prices are going up and we have FOMO. The stock market can stay irrational for years. Bond investors are different. They're institutional. They're calculating. They don't care about the stories or they hype. They care about getting their money back with interest. When bond investors start pricing in a recession, you should listen. Now, let's talk through the exposed record, right? In 1969, the yield curve inverted. The recession of 1970 followed within months. In 1973, the bond yield curve inverted. The brutal recession of 1973 to 75 followed. The stock market fell by almost 50%. In 1978, the yield curve inverted. The 1980 recession followed. Then it inverted again in 1980, and the double dip recession of 81 to 82 followed. The worst economic downturn since the Great Depression at that point. It actually exposed it twice. In 1989, the yield curve inverted, and the 1990 recession followed. In 2000, the yield curve inverted. The 2001 recession followed by the dot-com crash. In 2006, the yield curve inverted. Most people ignored it. The housing market was booming. Stocks were at an all-time high. CNBC was fucking celebrating. 2 years later, Lehman Brothers collapsed. The global financial system nearly ended. And it was exposed 2 years earlier. Guys, in 2019, guess what happened? The yield curve inverted. And people debated whether it still mattered. Maybe this time it was different. What happened? COVID hit in 2020, and the economy collapsed and we entered a recession. But the yield curve didn't know about COVID. It didn't know COVID was coming. It just knew something was wrong in the market. It senses fragility, and it has exposed it every single time. No misses, no alarms, no false positives. Now, some people will tell you that there have been false positives. They'll point to a minor inversion that didn't lead to an immediate recession. But when you look at the exposed data, every significant inversion, every inversion that lasted more than a couple of days has been followed by a recession within 6 to 24 months with 100% accuracy for 74 years. You find me another indicator with that track record. Here's the thing, you can't. So this is what we need to talk about, because in July of 2022, guess what happened? The yield curve inverted. The 2-year Treasury note rose above the 10-year yield for the first time since 2019. And it didn't do that briefly. It's still inverted. This is not the first time that we've talked about this, but this is the most serious time where we've compiled all of this data. And we've talked about this. You can see this on your own investment side of things. If you guys were to go out and invest in, like, let's say you went to American Express and you guys wanted to put your money into a CD, you will see this in your own personal investments because they'll have a 1, 3, and a 5-year note. If you go on to American Express right now to open up a CD, the 1-year note will pay you 3.5%, 4.5%. The 5-year note will pay you 1%, right? Because they don't want to lock you into these long-term commitments that they may not be able to follow through. So that is what we're talking about today. I hope you guys see, guys, I feel like I have the answers to the test sitting here in front of me, and everybody is pushing back, right? Oh, it can't happen again. Oh, Larry, it's different this time. How many times are we going to listen to that? Because they said the same thing in 2006, in 2005, and 2006. Hell, I got into real estate during that time because everybody was making so much money. And I was like, yeah, I want to make a lot of money. And then the market started crashing. And when it went, it went. So guys, this bond yield inverse, right, has, again, I just want to reiterate this to you, right? It's predicted every single US recession since 1950. There's never been a false alarm in over 70 years. Wall Street watches it. The Federal Reserve knows about it. Yet most people have never even heard about it. Why do we want to look at this? Right? It's because the recession, all of us are in real estate, guys. It affects jobs. It affects prices. It affects businesses. It affects investments. So this is where knowing these early warning signs, we can not just prepare for ourselves, but now we can start helping other people prepare as well, right? And this indicator generally gives us a 6 to 24-month head start. So I'm not saying that the market's going to crash tomorrow or anything, but look where we're at in this market, right? In the chat box, right? What's happening with consumer debt right now? Like, put it in the chat box. Like, from what you guys see, from what you guys know, what's happening with consumer debt? Is it high? Is it low? It's the interactive part. Yes, it's at an all-time high. Byron, talk to me, my friend. What you got over there? Skyrocketing. Byron, you can go ahead and unmute if you have something to say. I see your hand raised there. If not, if you were just raising to participate, I appreciate that as well. Oh, the gold and silver. Man, you know what, Byron? I actually almost added an entire section on the gold and silver indicator, but I was like, you know what? I'm going to do that a different time. So that is a huge point as well. Like gold and silver, oh my gosh, silver is at what? It hit $95 an ounce. So again, I don't want to go too far down that rabbit hole, but another phenomenal indicator that you guys should be looking at and stuff right now on that side. Natasha mentioned it as well, right? Consumer debt is at an all-time high. Auto default loans are going crazy right now. Defaults on everything is going up. So these are leading indicators, right? It shows me that we're not making enough or we're spending more than we're making, right? I don't know which one it is, but that raises our consumer debt. And then once that consumer debt goes up and we still don't have enough money or the problem hasn't been solved, now we have to start strategically defaulting, right? Which bills am I not going to pay? We start playing this float system. Well, I'm going to pay this one right now, and then next month I'll pay this one, and then I'll come back and pay this one. And we start playing this shell game on how we're going to pay our debts and stuff at this point in time. James Brown, who does a lot in the investment space, right, is talking that there's a ton of short sales from a lot of his wholesalers and stuff like that, right? Because the market's not going like this right now. What else, guys? Like for the first time, now, I don't know if this has ever happened before or not, but this is the first time I've seen it. Some of you guys, like I've only been in the market, in this space about 20 years now. You tell me if you guys have ever seen this, because I know some of you guys have experienced that trump mine by far. But have you ever seen a new home sell for less than a traditional home? This is the first time that I've ever seen that. I've seen new home communities be like 350 and offer more incentives, but I've never seen the starting price be less than a traditional home. And I'm seeing that in particular markets where people bought within the past couple of years, and the builders, I feel, are more bond investors where they're institutional, they're statistical, they're getting ahead of this because they don't want to be stuck holding the bag, right? In the last recession, right? Like people kind of ignored some of these signs. You saw new home builders fold up, right? You saw entire subdivisions sitting there empty at this point in time. And so, you know, again, I've kind of given a little bit, right? But the bond yield curve, just so everybody's on the same page here, is that the government borrows money, right, by issuing bonds. And we've talked that, you know, there's a 2, 10, and 30-year bond, and each pays a different interest rate called the yield, right? And a normal yield curve under normal conditions, right, the 10-year bond always pays more than the 2-year. I say always. In a normal condition, a 10-year bond always pays more than the 2-year bond. The long-term bond pays more than the short-term because there's more risk and you have to be rewarded for that. But then every once in a while, we get into this inverted yield curve. Something unusual happens and the short-term rate rises above the long-term rates. The 2-year bond will pay more than the 10-year bond. And this inversion is a warning. Investors are believing that the future is going to be worse than it is today. They expect slower growth. They expect lower interest rates. So they lock in money into the long-term bonds at lower rates. That is the bond market predicting trouble. That is what we are looking at on this. And that is the translation. And, you know, the bond market versus the stock market, right? The stock market is emotional, right? This is where you get the AMC movie theaters, the GameStops, right? Like, oh, like you get like the fans are rallying for this cry. Yeah, let's take down the big guy, right? It's this emotional game where they're trying to stick it to the man. And it can stay irrational for years. But the bond market is different, right? We're talking institutional investors that are risk focused, and their only concern is getting money back on their investment. Historically, more accurate. And when bonds warn about this, it matters, and we have to pay attention, right? I'm going to be having a follow-up call with Louis Amaya from PIMCO, because we've had a couple of calls the last couple of weeks where we can actually invest in NPLs, right? I see a lot of you guys were actually on those calls, which will create future inventory. That fund is going great. And in the beginning of February, there's a HUD loan that's going up that has over 4,000 loans going up for sale. That is 4 times the amount of the last auction that we bid on. These are indicators that tell me that all of these numbers are tracking, right? When we see these default ratios increase, when we see 1.5 million homes on the market, which is the most that we've seen since 2014, when you see it go from 2 months supply of inventory to 4 months to 6 months, guys, I've been looking over some BPOs and stuff that have 11, 12, 13 months supply of inventory. When you have that much supply of inventory, what happens to prices of homes when you're competing with that much inventory? Somebody put it in the chat box for me. It drops, it goes down, because that's the only thing that you can compete on, right? And so then you start racing down here. Now you see, the administration saying that, hey, maybe BlackRock can't buy this many homes. Maybe they're not allowed to own homes. That worries the hell out of me, because there's some investors that own tens of thousands of homes. If they start liquidating and pushing those homes onto the market, you think you think we're seeing price reductions right now? Like, we haven't even started this next cycle yet, guys. Like, that is where I want you to focus on. The things that we're doing today, like with the REO Alliance, with the Real Estate Alliance, with REOX, with 5-Star Institute, etc., is all to place our group ahead of the curve for the next 4 to 8 years. Because a lot of us were in that last cycle. And I teach agents to get into REO because it changed my life, right? Like, when you're selling 300 plus homes a year, you're not just helping yourself, you're helping so many other families in a down market, right? Create businesses, put food on the table, generating some hope in a downturn economy and stuff there. So that is why we do this, right? Like, that is why we have this mastermind, agents helping agents, because we can learn from each other. And a lot of us have been through multiple different markets. Yeah, I'm really interested in Vegas, Byron, because what goes up fast comes down very fast. And Vegas is notorious for that, right? Like, it climbs faster than everybody else, and it drops faster than everybody else as well. And so, we're keeping a very close tab on that for this next cycle and stuff here. So guys, I was a little animated because I get so hyped on this. I'm like, fuck, guys, how do you not see this, right? Like, I'm not making this stuff up. The numbers are telling us a story. Like, are you paying attention to the narrative that it's telling us right now, right? As many agents as I talk to, 2021, 22, oh, their best year ever. The most common theme about 2025 was it was their worst year ever. That is the most common theme that I am seeing across the country as I talk with man, I probably talk to 40 to 50 agents a week, getting them into the REO Alliance referral database and talking about business plans, introducing to new products or clients or whatever it might be. That's the most common theme right now. And so here's the thing, a lot of us were around, we were all around, but some of us were in the real estate market, right? But 2006 is a prime example. The housing market was booming. Stocks were at an all-time high. Media was optimistic, and the yield curve inverted in 2006. There are a lot of similarities. History does not repeat itself, but it rhymes very closely. 2 years later, Lehman Brothers collapsed, the global financial crisis. I don't know what the black swan event is going to be. I can't tell you that. Is it politics? Is it gold? Is it silver? Is it crypto? I don't know what that's going to be. But when one of those start to tumble, right, it sucks liquidity from the market and people lose options. So people might be hanging on to their home that is overvalued right now, right? Because they're like, oh, well, I have this money in stock. I have this money in crypto. I have this money here. But when that market turns, all of those investments go down and now they lose liquidity in the market. This is how we help position people that are starting to fall behind on defaults now. And when we know it's coming, we can help them position. Oh, I want to sell for this. And they have to sell, right? Because they want to see a profit. Look, I want everybody to make a profit on their home, but sometimes breaking even is the best thing that they can do, because if they hold on for it for too long, like they might lose those opportunities and end up taking a loss. They might end up screwing up their credit for 7 to 8 years. Guys, I'm speaking from experience, right? Because in 2005, 2006, I owned 5 homes in Phoenix. I had 2 pieces of property in Mexico. I had 6 figures in the bank account at the age of 27. I didn't know what the hell I was doing, right? I remember I had read some books and asked my mentors about an exit plan. And they were like, oh, like get a silver tongue, like don't worry about it. We'll do this, we'll do that. Well, here's the thing. When the market started turning, it started turning fast. I had 5 homes in Phoenix, Arizona that were partially remodeled. I could not rent them out. I could not refinance them and pull the cash out to finish the construction. I lost all 5 of those through short sale, through foreclosure. I used every dime in my bank account trying to save something that was never even savable. Like, I don't want anybody to ever go through that because it was painful. I couldn't use bank accounts, right? Like I was closing all of these deals and I could not even deposit money into my bank account because everybody wanted to take it from me, debt collectors and everything like that. I never want anybody to go through that. So this is where we help others learn the lessons that we learned faster. This is why I'm screaming this from the mountaintops. And I have some great friends that were posting some things that were like, oh, 2021, the average home price in Vegas was $350. 2025 was 2017. Same people that have been preaching about a crash for the last few years, it still hasn't happened. Like, yes, I don't know the exact date. It's not an if statement to me. It is a when statement. How are you positioned for this next cycle? That is where I want you guys doing. Here's the thing. You guys don't have to believe this. It's not going to affect me, right? I'm talking to my clients, my asset managers, all of these different people that I put a heck of a lot more weight on because I feel like they're smarter than me, especially in this default space. This is where we learn from others. If we are the smartest person in the room, wrong room, right? Level up our circle, level up our center of influence at this point in time and get to that next room. And here's the thing, guys, like, 2022 at the end of it, like in July there, the yield curve inverted, right? The 2-year treasury bond rose and it has stayed inverted. That is not a small inversion. It's not a blip. It is still inverted. That is the part that scares the shit out of me. Excuse my language. Right? And so 2023, it triggered again, not just flashing, but it's screaming. And so if history repeats itself again, as it has for the last 70 years, since we started tracking the bond yield curve, it is a huge concern to me. The more you know about this, the better you can help your clients, the better you can educate your clients on pricing the appropriate way today versus it being too late and you starting to chase the market. Chris, The Big Short, like absolutely. Like The Big Short, like, oh my gosh, how do you guys not see this? Right? Like this is the time to go and watch that. Because you can learn a lot from that. And he noticed the garbage that was out there and stuff there. And here's the thing, this isn't on the news. Why? Because it's not sexy. It's not flashy. There's no drama. There's no hype. Like who the hell wants to talk about a bond yield curve? It's hard to explain, right? In short periods of time and stuff there. And it doesn't benefit short-term optimism. Now, I don't think the news like sells optimism very much at this point in time, right? It's fear and all of this other stuff, but still, right? It's hard to make a bond yield curve look sexy, but it still remains one of the most reliable economic indicators. And so here's the thing, guys, like the key takeaways is the yield curve has predicted every recession since 1950. Zero false alarms, zero false positives. An inverted yield curve equals a recession warning. The signal is currently active. And so understanding this change and how you see the economy not just helps set up your future business, but it helps you apply this to other people that are looking to invest. Look, investing is not good or bad. There's investments in an up market, there's investments in a down market, but the people that I'm working with on investments, even with PIMCO, our buying has to be better. Because if I bought a note at 65% of market value in an up market, that's a crazy deal. If that market starts slipping and coming down, those margins start tightening really quick. So we might need to buy at 50 cents, 45 cents on the dollar. This is where Carrington, right? I grew Carrington to 3,000 agents around foreclosures because they bought the New Century portfolio. Those of you guys that were around, New Century was notorious. 400 FICO score, like you're breathing, zero down payments, like loans that should have never been giving out. Carrington bought that entire portfolio. I don't know the rough amount, but I would venture to say less than 25 cents on the dollar. So even if the market pulled back 40%, they still had a 35% spread in there. Those are the opportunities that you want to take advantage of. That is why we have these calls with PIMCO where you guys can become investors or you guys can bring your investors in and we start creating our own future inventory because we've been through these cycles before with this group like the REO Alliance that we put together. Like this, we're not making this shit up, right? We've seen these cycles before and we're trying to get ahead of it. So the yield curve doesn't predict events, right? But it reveals a fragile market. And if you guys don't think the market is fragile, then you keep running in your lane and you be the best as possible for it. But when the bond market starts to speak, right, history tells me that we should be listening and stuff here. And so that was the messaging for today. And I know that is a hell of a lot, to kind of go over, to digest and everything else. But questions, comments, concerns. And again, this isn't me, like the market is not good or bad. right? It just happens because greed comes into play and we want to take more chips on the table. And how can we do this, right? And we keep wanting more and more and more. And you see that with investors that got into real estate in 2021. And they took one flip and they turned it into two and turned it into four and turned it into eight. And now they have this huge portfolio. They might be running 20 and 30 homes. If they get stuck with that when the market turns, everything that they made goes up like that, right? So again, this obviously I'm a little bit passionate about this. One, because I have past trauma from living through this and all of the experiences, lessons that I learned, right? They weren't mistakes because I couldn't be where I'm at today had I not gone through those experiences. I wouldn't have the relationships. I wouldn't have got into REO. I wouldn't know a lot of you guys, right? So I'm not happy or sad. I needed those experiences to be where I'm at today. Now, full disclosure, I never want to go through that again, which is why, like, I have money in reserves. My credit score is better now. Like, we're looking at all of these other investment opportunities. But what can I answer for you guys? Anybody have any other feedback on that? Anything that I missed? Anybody disagree? Like, this is a mastermind and I want to be fully transparent on that. Byron, maybe you could jump in and talk about the gold and silver and just give like a high level overview of what you're looking at there, because I will come out with some content and stuff on the gold and silver market as well, which I think is an indicator at the same time.
Well, you know how fast it's kind of happened in the last year or so. Silver with AI and now data centers and different things where it has to be used. China
Yeah.
holding off, selling, and the BRIC nations doing what they're doing. But
Did you also see that yesterday the U.S. Mint stopped releasing, like we're no longer selling to the public as of yesterday?
yeah, I hear that, and then I hear dealers are turning constitutional silver or certain coins, whereas the coin nobody could possibly buy that barber dime or whatever it is for $35, so they're turning it into melt. Big places aren't buying sterling, and then nobody can hold on to these coins, and then gold's obviously just sitting, and everybody that has it, it's happy. But and if they're melting Rolexes or Patek Philippe's or Richard Mille watches just for the gold content, that's kind of a scary situation in my mind, just because the average person, there's no entry point. And if there's no entry point for that and bread goes to $5 or $6 or $8 and the average person can have a lot of problem, then they're going to be big defaults. And they're already seeing it here just because of the tourism slump and other things. It's not really drastic because I feel like the loans are, pretty good. It's kind of been hard to get loans. It wasn't like the big short days when I started and saw people like, that had money lose everything. And I watched them lose everything, et cetera, et cetera. This was like the epicenter of it.
Yeah, and this is where like this next cycle won't be caused by real estate, but I don't know how real estate can hide from it. I don't know how real estate is not affected when you lose that liquidity from stocks, from crypto, from gold and silver, or lack of gold or silver or whatever that might be. But I appreciate you kind of pointing that out, and like I'm doing a deep dive and stuff on that right now, and yeah, we'll have another call somewhere down the road on gold and silver specifically, because that also tells a story when a currency is losing momentum. So generally, you don't see gold and silver going up when the dollar is holding strong and stuff there. Now, there could be some other things with oil and stuff. So again, I don't want to make this about that because I don't have all of the data to support, my thesis on that at this point in time. But I appreciate that feedback there, Byron.
Yeah, it's just the main, if our currency goes away and everything, we got a real problem if it's not gold based, if it's not oil based, and it's not dollar based.
Yeah.
It can happen so quick, and that's like what you're saying, because it's been a lag, right? It's been like 2 year lag since this inversion. So anyway, that's my point. Thank you.
Yeah, I appreciate it, brother. Anybody else? Are you guys seeing anything different? You guys have anything to add to that?
I can tell you, Larry, that everything you said today was appreciated and spot on. I think what I'm seeing, and I think what we all are seeing as agents right in front of us, we need to pay attention to the notes of defaults, the notes of trustees in our market. We need to pay attention locally because that gives us an indication of what's happening next. I don't want anyone to lose their home at all.
Yeah.
Reaching out as a traditional real estate agent to those folks that are in distress, that need help, and it's building my traditional business as I position and prepare for what's next potentially. And I'm already seeing it. You and we're sending out asset referrals all over the country. Larry, I'm getting calls every single day from asset managers. Who do you have here? Who do you have here? So pay attention to the notes of default, in my opinion, and position yourself for what's to come next. And that's I know that's the common theme we've talked about a lot. So just a reminder.
Yeah, absolutely. And Robert, one of the things that you and I should work on, I know Eric Bangalid and I had created like an interactive like map of our referral resources and stuff like that. It hasn't been kept up, but I feel like we could come up with our list, download it. So because I know you and I are like, hey, do you have anybody here? Do you have anybody there? Right? If there was just this map now, like, and it would take a little bit of time to get it updated. But then if we kept it updated every single day, like it could be really fast for you, for me, for our other asset management clients and stuff that get involved in stuff as well. So you and I should put that on our list to work on. And I don't think it'll take
Absolutely. And this is the go-to group. I always call you first. I get a lot of calls. I call you first, and then we go to the group that gets involved here. And I really appreciate everybody on this call for being a great resource.
Yeah. Thank you for all you do, man.
Absolutely, sure. Brother.
Anybody else, guys? Anything that would clear up? Questions? So that's all I got for today.
Larry, I have a question for you, Larry. I just want your thoughts. I feel like there's a sleeping giant that doesn't have any indicators that I haven't really heard anyone talk about in the REO space at any of the conferences. And it's the sector of the workforce that is very soon going to be replaced by AI. A lot of that population owns homes, right? So, like, is that being baked into what's coming? I mean, what are your thoughts about that?
So that could be part of the fragility of the market, right? That, and again, like the bond yield curve doesn't tell you exactly what the vent's going to be. It's going to tell you like, look, there's some cracks in this dam, right? And so that's where it could be one or a combination of all of these different things that we've talked about on this call, right? Because we've talked about a number of different sectors and stuff like that. Now, with AI, I don't think that like it makes things more efficient. And as it takes away, it also, you know, as it takes away job opportunities, it creates other job opportunities. I don't know what that ratio looks like, right? I don't know if, 5 jobs are replaced as every one is taken away. I don't know if 5 jobs are taken away for every one is replaced. And that's where we don't really have the data to kind of say, oh yeah, this is what AI is doing or not. Right now, look, there's data centers, there's this, right? It's like it could be a wash right now. It could not be. I'm just like brainstorming here because I don't actually have the answers, right? But I'm not just convinced that it's this negative sum game with AI at the end of the day, because it's putting together a lot of tech, a lot of IT, a lot of infrastructure, right? Like there's all of these other pieces that are going into place. Now, how much of that is automated and stuff, I don't know. So I know that's probably not a clear answer, but I don't have the data because it's such a new emerging market to see what it's actually doing. There's a lot of, oh, this is going to take away all the jobs and stuff. I'm not convinced of that. It will open up other opportunities for people. it will help the better people become more efficient and help more people and build bigger groups and teams and stuff like that. Well, you have companies of 1,000 people at AI companies. I don't know, probably not. Like, but I really don't know. It's all fugazi. It's all made up at this point in time, and I don't know who, like, if anybody actually has the answer.
Thank you so much, Larry. Hey, this is Latika Archuleta. I'm in Atlanta, Georgia metro area, and this is an awesome presentation because I felt a lot of apprehension in our local market since the last fall. It really became a buyer's market, a buyer market here. I noticed when I would take my buyers out, agents would be begging me to choose their house. So it was a total different kind of pick me situation. I was able to negotiate some phenomenal transactions for my buyers. I'm talking 20, 30, 40,000 off of list price, which is crazy. Now I'm starting to see short sales and I've been having a lot of anxiety myself. I have investor that has a couple fix and flips that have been on the market way too long for completely renovated property. So this is something that I appreciate you bringing to the table and giving everyone opportunity. I was here during the crash. I sold new homes and I was a part of that whole situation where nobody came out. It seemed to crash and fall off a cliff at one time. And my builders had all of these, sewer connects poking out the ground and no homes. So to be ahead of the curve, I do agree with someone that mentioned the job loss affecting people because I have had some previous clients come and ask me about loss mitigation options. I used to be a HUD-approved housing counselor and I did a lot of short sales. So I know that aspect of it as well. So I would just encourage people not only to do the REOs, but how I got into REO back then was everybody was calling me to save their home. I didn't know what to do. I hate not having the answer, and I really wanted to help my clients. So I learned how to do loan modifications. I learned how to do short sales. I learned how to do those things before I even had an REO opportunity. So in the meantime, I would just encourage people to learn how to do those things to help people in addition to if they fall on the other end and somebody's lost their home, then of course you can pick it up on that back end. But there's this other thing of the door knocks and just trying to calm people's anxieties and help them. So thank you so much because something's coming.
Yeah, absolutely. And again, like there will be opportunities as well. Like it doesn't have to be like, oh, the market's going to hell, our lives are going to hell. There's going to be opportunities for us to help a lot of people. I love the fact getting it before the REO sector and stuff gets involved, before they're foreclosed, right? I think that's the biggest opportunity to create raving fans and get ahead of that curve. And help people out to where their credit's not ruined. They haven't gone through all of these other things. And then even once it gets to REO, how do we help somebody get the most in cash for keys? How do we get, our clients being the banks, that home back in the best possible scenario? So this is where we become kind of a middleman or middlewoman, right? And we just try to help as best as possible. Like both sides come together. Wonderful. Anything else, guys? Well, I appreciate all of you guys. I hope you guys got some value and stuff out of this. I hope you guys use this for something in your business, right? There's a lot coming down the pipeline and stuff like that. We'll have the replay and stuff out on YouTube if you want to go back and look at any of this info and stuff like that. But I appreciate all of you guys so much. Literally my favorite call of the week because of the people, like I get all of you guys who I love all in one place at one time. And that's very uncommon with the range of our group and the location of our group and stuff like that. So I love you guys. I thank you guys. If I can help you guys in any way, shape, or form, reach out to me and I'll talk to you guys soon. Have a great day. Bye, guys.